Hello, financial enthusiasts. Today, we're taking a deep dive into the world of bonds, a foundational element of conservative investing. I'm Wise Insights, and in this segment, we'll unravel the complexities of bonds, dissect the concept of fixed income, and explore why these investments are often hailed for their stability in the financial landscape. Understanding bonds. At its essence, a bond is a debt security. When you invest in bonds, you essentially become a lender. Whether it's a corporation or a government entity, the issuer agrees to pay you periodic interest over a predetermined period. At the bond's maturity, you receive the principal back. In essence, it's a structured IOU, providing a fixed income stream to the bondholder. Fixed income and stability. One of the fundamental attractions of bonds is the promise of fixed income. Unlike stocks, where returns can be highly volatile, bonds offer a predictable stream of interest payments. This stability is particularly appealing to risk-averse investors or those seeking to balance their portfolio with lower-risk assets. The fixed income from bonds can act as a ballast, providing stability even during turbulent market conditions. Risk and returns. While bonds are generally considered low risk, it's essential to understand that they are not entirely without risk. Two primary factors come into play: interest rate risk and credit risk. Interest rate risk is the potential for the value of existing bonds to decrease if market interest rates rise. Additionally, the creditworthiness of the issuer plays a crucial role. Government bonds are often perceived as safer than corporate bonds due to the sovereign backing. It's a delicate dance between risk and return that investors must navigate. Types of bonds. Bonds come in various forms, each with its unique characteristics. Government bonds, such as US Treasuries, are often seen as the safest investment in this category. These are backed by the full faith and credit of the government. Municipal bonds fund local projects and are issued by municipalities, offering tax advantages. Corporate bonds involve a higher level of risk but can provide higher potential returns. Understanding the types of bonds helps investors tailor their portfolios to match their risk tolerance and financial goals. Advantages of bonds. Let's explore the advantages of including bonds in your investment strategy. First and foremost, bonds provide income predictability through fixed interest payments. This can be especially beneficial for retirees or those relying on a steady income stream. Secondly, they act as a stabilizing force in a portfolio, cushioning the impact of market volatility. During economic downturns, the consistent income from bonds can offset losses from riskier assets, fostering a more balanced and resilient investment portfolio. Drawbacks of bonds. However, it's crucial to acknowledge the drawbacks of bonds. In a low-interest rate environment, the yield on bonds may not keep pace with inflation, potentially eroding the purchasing power of investors over time. Additionally, when interest rates rise, the market value of existing bonds may decrease. It's a trade-off between the stability and income provided by bonds and the potential for higher returns in riskier investments. High-yield bonds. High-yield bonds, also known as junk bonds, offer higher interest rates than investment-grade bonds. They are issued by companies with lower credit ratings, which means they carry higher credit risk. Investing in high-yield bonds can potentially provide greater income, but it comes with a higher risk of default. Longer-term bonds. Bonds with longer maturities generally offer higher yields than shorter-term bonds. However, longer-term bonds are more sensitive to changes in interest rates, which can lead to greater price volatility. Consider your interest rate outlook and risk tolerance before investing in longer-term bonds. Emerging market bonds. Bonds issued by governments or corporations in emerging markets often offer higher yields compared to bonds from developed economies. These bonds also come with higher credit and currency risk. Investing in emerging market bonds can be rewarding but requires careful research and risk management. Bond funds. Consider investing in bond mutual funds or ETFs that specialize in higher-yielding bonds or specific sectors. These funds offer diversification and professional management, which can help maximize returns while spreading risk. Active management. Some investors choose actively managed bond funds or portfolios. Professional portfolio managers actively select and manage bonds to try to outperform the broader bond market. Keep in mind that active management comes with management fees, which can reduce your overall returns. Laddering. Implement a bond ladder strategy by investing in bonds with staggered maturities. This approach allows you to maintain a consistent income stream while having the flexibility to reinvest in higher-yielding bonds as interest rates change. Credit research. Conduct thorough credit research to identify individual bonds or issuers with higher yields but still reasonable credit risk. You can potentially find opportunities in sectors or companies with improving financials. Tax efficiency. Consider tax-efficient bond investments. Municipal bonds, for example, offer interest income that is often exempt from federal income taxes and, in some cases, state and local taxes, making them attractive for certain investors. Diversification. Diversify your bond portfolio across different types of bonds, sectors, and geographic regions. A well-diversified portfolio can help spread risk and reduce the impact of individual bond defaults. Risk management. Keep a close eye on market conditions and interest rate trends. Be prepared to adjust your bond portfolio as needed to manage risk and seize opportunities. It's essential to strike a balance between seeking higher returns and managing risk. Higher-yielding bonds typically come with greater risk, so make sure your investment choices align with your risk tolerance and financial goals. Additionally, consider consulting a financial advisor or investment professional to help you make informed decisions based on your specific circumstances. Bond funds, also known as fixed income funds, are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of bonds. These funds are managed by professional portfolio managers who make decisions on behalf of the fund's shareholders. Here's a detailed description of bond funds. Diversification. Bond funds provide individual investors with access to a diversified bond portfolio, which can include a variety of bond types such as government bonds, corporate bonds, municipal bonds, and mortgage-backed securities. This diversification helps spread risk across different issuers and bond categories, reducing the impact of a single bond's performance on the overall fund. Professional management. Experienced portfolio managers actively manage the bond fund's holdings. They make decisions regarding which bonds to buy and sell, when to reinvest interest income, and how to adjust the portfolio to align with the fund's objectives and market conditions. Liquidity. Bond funds offer liquidity to investors. Unlike individual bonds, which may have limited liquidity in the secondary market, bond fund shares can typically be bought or sold on any business day at the fund's net asset value, NAV. This makes it easier for investors to access their money when needed. Income generation. Bond funds generate income for investors through interest payments made by the underlying bonds in the portfolio. This income is distributed to shareholders in the form of dividends or interest payments. Investors can choose to reinvest these distributions or receive them as cash. Professional research. Portfolio managers and their teams conduct extensive research and analysis to select and manage the bonds within the fund. They assess credit risk, interest rate risk, and overall market conditions to make informed investment decisions. Risk management. Bond funds typically have stated investment objectives and risk profiles, allowing investors to choose funds that align with their risk tolerance. For example, some bond funds focus on higher-yielding, riskier bonds, e.g., high-yield or junk bonds, while others prioritize safety with government or investment-grade corporate bonds. Expense ratio. Bond funds charge management fees, which are typically expressed as an expense ratio. This fee covers the costs of managing the portfolio, research, administrative expenses, and marketing. It's essential to consider the expense ratio when evaluating the cost-effectiveness of a bond fund. Exchange-traded funds, ETFs. Exchange-traded funds, ETFs, are investment funds that are traded on stock exchanges, similar to individual stocks. ETFs can hold a variety of assets, including stocks, bonds, commodities, and more. Below is a detailed description of bond ETFs. Structure. Bond ETFs are structured as open-ended investment funds, which means they can create and redeem shares based on demand. This allows ETF shares to closely track the net asset value (NAV) of the underlying bonds. Liquidity. Bond ETFs offer high liquidity, just like stock ETFs. Investors can buy and sell shares of a bond ETF throughout the trading day at market prices. This flexibility provides easy access to the bond market for individual investors. Diversification. Bond ETFs hold a diversified portfolio of bonds, similar to bond funds. This diversification helps spread risk and allows investors to access various bond markets and sectors in a single investment. Transparency. ETFs disclose their holdings on a daily basis, allowing investors to know exactly which bonds are held within the fund. This transparency provides insight into the fund's composition and risk exposure. Income generation. Bond ETFs generate income through interest payments from the underlying bonds. Like bond funds, this income can be distributed to shareholders as dividends or reinvested. Expense ratio. ETFs typically have low expense ratios compared to many mutual funds, making them cost-effective investment options. Investors should be aware of management fees and other costs associated with the ETF. Trading flexibility. Investors can use ETFs for various trading strategies, such as day trading, swing trading, or long-term investing. They can also be bought on margin and sold short, providing additional flexibility. Thank you so much for tuning in to Wise Insights today. I hope you found this video on bonds and ETFs both informative and valuable for your financial journey. We've covered a lot of ground in this video, from the basics of bonds and ETFs to strategies for maximizing your investments. Remember, investing is a long-term game, and making informed decisions is the key to financial success. If you have any questions, comments, or if there's a specific financial topic you'd like us to cover in future videos, please don't hesitate to let us know in the comments section below. We love hearing from our viewers and addressing your concerns. Don't forget to like this video if you found it helpful and subscribe to Wise Insights for more valuable content on finance, investing, and making the most of your money. You can also follow us on social media for updates and additional insights. Before we sign off, I want to express my sincere gratitude for your support. It's because of viewers like you that we can continue to create and share these educational videos. Remember, financial literacy is a powerful tool, and with the right knowledge and discipline, you can build a secure and prosperous future. So, stay wise, stay informed, and remember that your financial well-being is within your reach. From all of us here at Wise Insights, thank you for watching, and we'll see you in the next video.